All right. Good afternoon, traders. Happy Tuesday, everybody. Gosh, this is the third one today. We're gonna do it again in 2 weeks. We're gonna meet 3 times. It's like an embarrassment of riches. I get to hang out with you guys. Love it. Welcome out to the Tradespoon Active Investor Workshop. Every other week, we get to have a discussion. I like how you put it, Phil. You say you look forward to the discussion. That's really what it is. I find that discussions are more productive than necessarily just like a presentation. You can go watch a video about a presentation. I'd rather show what does the strategy look like, what does it feel like, what does it look like if it goes ugly, what does it look like if it goes right, what are we expecting? I find that these discussions, particularly when it involves advanced options, you'll hear that thrown out. Basically, advanced options is anything other than a single leg option, right? You buy a call, you buy a put. Even if you're selling, right? You start selling a put, you're naked, right? You start combining options and you get spreads. Buy one, sell one, same strike, different expiration. It's a calendar spread, same expiration, different strike. That's a vertical spread. Different strike, different expiration. That's a diagonal spread. We can do butterflies. We can do iron condors. We can do ratio spreads. We've got a lot of different ways to build and manage options trades. I find that even if you're not interested in one style, learning kind of what it means, just kind of helps to sort through it all. How the option Greeks relate and are applicable when you're talking about an advanced option strategy. This is one I think that you've probably heard about, but maybe don't necessarily have a good handle on callers. And I'll tell you, I'm going to be honest with my opinion on the different types of strategies, how often I would use it, when, and I don't trade a lot of callers because it's a very defensive strategy. You might find yourself in a situation where you need it or want it. Maybe you're trying to get through the end of the year. If you have a trade that's right around a year's length, um, you own a stock, you own a longer term option. Remember that if you own it for less than a year, your gains will be washed out and then taxed according to your your income tax bracket. So if you're in a high tax bracket and you have trading gains, short-term gains are going to cost you a lot, right? If you hold for a year, then they're subject to the long-term capital gains, which is only 15%. So if you find that you're close with something and you're like, I want to get that, I want to get that to a long term, but you don't want to take risk during the next month or two, something like that. A great example of a situation of somebody doing a caller. You got to go back a ways now, but if you know the Dallas Mavericks owner, Mark Cuban, sold his company to Yahoo back in like 1998 or 1999, and a bulk of the payment came in Yahoo shares, so they didn't have to pay cash, right? So he got the shares and was smart enough as he had to hold them for a certain period of time. He couldn't just get them and start liquidating them. And so as the market started to crash, he had put a collar on, and it was a protective move. Because the thing about a collar is it doesn't just protect you from it dropping, it also stops it from going up very much. That's the thing as you start getting into advanced option strategies and advanced option strategy discussions. When you learn a new strategy, make sure you know all sides. What does it give me? And then on the other side, what am I sacrificing? Everywhere you go in trading, you got to know what the pawn is. And when I say know what the pawn is, it's know what you're willing to sacrifice in the greater good of the game. So in this scenario, what you want to realize, this is a very defensive strategy right off the bat, a very defensive strategy. And if you're going to defend something, the question you would ask is, well, why am I defending as opposed to closing and then moving that money to maybe somewhere more useful? So if you're asking that question, my answer would be, you're right to consider that. Callers have a very limited place in a portfolio right off the bat. So as we're going through here, because this is an advanced options slash collars, I'm going to open the discussion, open the question and answer to anything advanced options. But this is what we're going to be going through. I'm going to show using stock. So it's defensive in what way? It's a protective trade. What am I going to protect? I can protect a stock position. So if I own a few hundred shares of a stock and I get to a point where I'm like, oh man, this looks a little iffy. Well, if I still want to own that stock, whether I need to for some reason, I have a holding period, whether I want to because it's getting close or it's close enough to a long-term gain that if I can maintain the gain and get it another month or two forward in time, my tax bill might go from 38% to 15%. Well, that's a big deal, right? I mean, if you have a $10,000-$20,000 gain on a stock and you're thinking about taking it and you can push it forward, $20,000 gain when you're talking about a 23% difference in taxes, that's $4,500. Would it be worth it for you to put a collar on it, carry it for an extra month, get where you're at your 1 year point, and then say now I can get out? Hell yeah, that makes a lot of sense. So, anyways, if you have a stock portfolio and you start getting into a situation right now, my posture is bullish. I'm bullish. I would expect most of you are bullish. The market's been going up. Not necessarily today. I'm not saying I'm bullish today. I'm saying in general. But I am bullish. If my posture starts to change and I say, gosh, you know what? I'm seeing the fear rise. I'm seeing the trends are getting broken. The sellers are showing more strength on the selling days and the buyers less on the buying days. I'm seeing defensive sectors moving to the top and more aggressive sectors to the bottom of those. If I see that kind of thing start developing, well, then collars would make a lot more sense at that point, right? Then we do want to play some defense. So the strategies you pick certainly should be 100% correlated to your overall posture on the market. All right, let's dive in. Will I discuss when, why, and what would be the trigger? See, that's the thing, right? It's less a timing strategy, Cecil. That's a great question. The first thing when is when you want to protect it. Why would I want to protect it? If I have some signals that are coming out that say it might drop, but I'm not willing to sell the stock yet. If you get signals that it's going to drop, you could tighten your stop, and then if it stops you out, you're out. But a collar is, I want to keep the underlying trade. That's the first and most important why. Why am I doing a collar? I want to protect it, and I want to keep the underlying stock. So when would be if I see signs, and we'll go through some charts and talk about like, oh, well, if we start to see a lower low, lower high, and we think, man, this thing could roll over and drop, we could collar it and see what happens. So there you go. My name is Scott Beck. I am the head trading coach here at Tradespoon. I know some of you are regulars. You come to the trading rooms. We love you very much. Some of you are just looking at what Tradespoon has to offer. So just real quickly, obviously, we have some phenomenal technical analysis tools, proprietary algorithms that, in my opinion, produce some of the best looking predictive charts in the markets. We have great education, like these active investor workshops are all archived. You could go back and look at all of them. Obviously, we have handsome and charming instructors, right? So come on. So I hope you like what you see. Keep in mind, if you are, evaluating, that if you ever do sign up, you always have a 30-day money back guarantee. So if you ever come in and you say, this looks great, then you come in and you say, you know what, I'm not sure, it's not for me. Great, no problem. Um, just keep that in mind. A little bit about myself. I've been trading now for going on over 20 years. I have been coaching, teaching, mentoring for about 18. I might be at 22 years of trading now and 18 of teaching. That sounds about right. 99 to 2003. Yeah. 22 years trading, 18 years of teaching. That's me. Need to remind you before we dive into some of these advanced option strategies that trading in options in particular can involve substantial risk and may not be suitable for all investors. Please read characteristics and risks, standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks and be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results, should be considered. Lastly, I and/or the team of Tradespoon may have a financial interest in the securities presented and the trade picks. Okay. Oh, sorry. Let me finish this one. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block of FINRA and SIPC member broker dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. Pat, can I just tell you, you're quickly becoming my favorite person. Says I am a member of this room, and it's great, and the room is great. So I appreciate that. And I appreciate your attendance and participation. Okay, let's dive into this. So what do we need? We really don't need a lot of the tools that we tend to supplement with, right? I look at Yahoo Finance, I look at Market Watch. I mean, realistically, one of the tools we would definitely use would be, the market forecast, both from a short-term and a longer-term prediction. So if we start to see things that we think indicates weakness, then we will have something that we need to protect. But I'm going to actually come in. I'm going to set up, whoops. I'm going to set up some scenarios for this. So remember, what are we protecting? We're protecting something longer term that's bullish. What does that mean? I'm protecting stock. How about show the predictive chart against historical? Well, in fact, that's actually on there, right? So if you notice, the you have actual quotes, predictive quotes, and then the next day preview. So back here, you actually have a little bit, so you can see that there's a little bit of distinction. This is what was predicted. This is what happened. And then on this day, this is what is predicted. This is what happened. And so you can see for the most part, there's a little bit of disparity here and there, but this is exactly what that shows. So what I would recommend you do, your name didn't come through, but if you look and you go back in history, yeah, you can see what was predicted versus what actually happened. And then you can see what is the prediction for going forward. So at any given time, that information is available to you. And we can go into the long term as well. So the lighter is what was predicted, The darker is what actually happened, and then this is what is predicted for the future. So you can see that the prediction was actually not quite as strong as what actually happened. The model predicted that it was going to go up, but it didn't predict that it would go as fast. It definitely topped out around the same time. This is what we're seeing now. That is your predictive versus historical. You mean the larger predictive charts versus historical with somewhat parallel price lines? Yeah, I'm not exactly sure what you mean as to how I would express that. This literally is exactly that. I mean, you could always take this and look and then go see, but yeah, this is one versus the other. This is all you have for historical. So okay, so let's talk about these callers. What are we collaring? What does it mean to us? I'm collaring something bullish, a stock or a leaps contract, right? So the leaps contract would be something that would be at least a year, although it doesn't have to be. I mean, if, I can't think of a good scenario where you would want to put a leap or a collar on like a 3 to 6 month option. Usually it's just going to be to give you a little bit more time. So I'm going to go in. Let's just, I'm going to run through some charts and just see if I can't find something that's maybe turning a little sideways. GDX is already down. Yeah, home builders maybe. Looks like it's struggling a little bit. AT&T's already down. Oh, let's just take home builders, for example. What do I have? Let's say that I own some XHB. I've had it I bought it back here in October around 57. It's up here now, 75. I'm only a month away, right? I'm only a month away from my long term. I've got a nice little gain here. Let's say I did 500 shares. That's $18 a share, 500 times, right? That's a nice little gain, $9,000. If I sell it now, it's short term, and I'm going to get taxed about 40% of it. You mentioned buying the collar to prevent short-term capital tax consequence, but could the put premium? No, because remember, your put premium, which will be short-term, will be offset, and you're not selling the put. You're buying the put. So buying that protective put, if you don't need it, is a loss, and that loss will be offset. Remember that your short-term all wash out over time. You add up all your short-term gains and losses and whatever is at the end. That's what you'll have, right? So what you're trying to do here would be to kick this, either protect it because you just want to stay in it, whether you're restricted, whether you're just committed to the longer term, whether you're close to a short-term gain or loss. But anything you did for that month, you're not going to sell a 1-year covered call. You don't need it. You only need it for a few months. That's one of the things you would have to think about. How long do I need the collar for? Exactly. I need it for a month. All right, so I might go 6 weeks, 8 weeks. And the construction of a collar is pretty simple. Whatever you have that is longer term bullish, whether it's stock or options, long-term options. I have either, let's say, 500 shares, or I have 5 contracts that are out to January that I bought way back when. What I'm going to do is I'm going to sell calls against that. So if I have a stock, I'm selling covered calls, right? They're covered by the fact that I own the stock. So I'm selling calls to generate premium. That premium would, yes, be short-term gain, if I keep it, right? But remember that I'm going to use that short-term gain to buy short-term puts. So essentially what I'm trying to do is not have to pay out of pocket for my insurance. The insurance is the puts that you're buying. When you buy puts on stock you own or options you own, you are hedging. That's a hedge. You're paying out of pocket to buy a protective insurance policy that says this policy will go up if the stock drops during this period of time. So a lot of times when you buy insurance, when you buy a hedge, you are paying out of pocket for it. So instead, what you would be doing here is leveraging the ownership of the stock to sell calls. And when you collect premium, you use that premium to then turn around and buy your puts, your protective puts. So people, it's not free. It's not a free put, right? It means you're not paying out of pocket. You collected premium by leveraging the ownership of the stock. Now you might think, well, then how do I do it if I have a LEAPS contract? So a LEAPS contract obviously can't participate in a covered call. You're not covered by the LEAPS. That sounds like a wash. You sell calls to buy puts. That's exactly what it is. It's a wash where? At the current price. Yes? So you would be selling calls far enough out of the money to, and you can decide, would I want to, so the advantage is I don't want to get out of this before October 30th, 13th, 20th, whatever it is, right? Let's say it's October 20th. So what would I do? Okay, so let me build this in the analysis. Let's say that I own 500 shares of XHB at $58 because I bought it back here. I bought it at 57.50. Let's call that 57.50. That's the example. I bought it at 57.50. So I've got a nice gain here, 9,000 almost, 89.55. But I bought this back on October 30th. So if I sell it now, that's a $9,000 short-term gain. The point would be to extend the gain into the long-term realm, because then I get to realize this and pay a significantly lower amount, right? I would rather push this, if I'm close, out of the short-term column into the long-term column. The mechanisms I use would likely break even, right? It's a wash. I sell and let's go to November. That gives me enough time. Ooh, I don't have Novembers. Let's go to December then. We'll go 3 months. We'll collar it for 3 months. So what am I going to do? I'm going to sell, and I can go a little bit, like give myself a little range. Maybe I go, actually, no, let's go right at the money. So I sell a 75, that collects $3.20 of premium. And I sell 5 of those. Whoops. So what have I done? I've now capped myself. I can't make more than this, but I can make this, right? I can make this all the way from now until December. In December, if the stock is above 75, somebody's going to force me to sell it to them for 75. That's the gist of this, right? That's the gist of this. I'm going to have to sell it for 75. But what we're saying is 75 is what's producing this gain that we're happy with. We just want to push the gain beyond October. Or, like I said, if you ever sell your company and you have thousands and thousands of shares of a stock that you are not allowed, or this might be a case in your employer. If your employer has stocks that they give to you, and you're locked in, right? You have a vesting period. You can't sell them before a certain amount of time. You can protect them using collars, right? That is absolutely another scenario where this might play out. If you have a large stock portfolio and the market looks like it might crash, collar it. You can definitely collar it. What does a collaring do? You're not going to make more than this, not during this period of time. Then what would I do next? Then I would say I'm going to buy December 75 puts. So I buy these. Now this is not a huge, like the with the market closed, I'm not getting great spreads here, but I'm going to basically assume I can buy for 350 and then, sell for 350 and then also buy for 350. That's kind of the objective. And I'm going to do 5 of these, right? Now, when I look at my risk profile, what do you notice? No matter what happens, now let me point this out. This is important. I'm up 87.50, right? Without these options, right now, I'm up. Let me make this a little bit easier to see. Right now at 75.41, I am up. I don't know why this is locked in here. Give me a second. There we go. I'm up about $8,900. Right now, if it were to drop back down because I was trying to hold on to it and all of a sudden it drops to 57 because I'm just trying to improve my tax situation, I'm going to feel like a Yahoo. I just gave it all back because it fell. So in order to prevent it from falling, but allow me to extend the gain into the long term, I put on and again, I do have to say that I am not a tax professional, so you would want to consult with a licensed tax professional. But these 2 trades would be short term. If I gain on one, I lose on the other, and they would wash each other out. So they would have 0 impact overall on my short-term gains. I would gain on one and I would lose on the other. Right? So that's the situation. But if you notice, no matter what, the stock could drop down to $20 a share and I am still making $8,750. But the stock could also go up to 110. And if it goes up to 110, I'm not making any more money. I'm at 8,700. So this will get me through to December 17th. And it basically, the collar is, it can't go anywhere. I put a collar on a dog and I leash the dog. Where's the dog going? Nowhere. Nowhere. Not going up, not going down, staying right here. It's collared. It's collared to me. It's collared to this price. You can see that there's like these little peaks, literally like $50 peaks that show like little minuscule time decay changes that are not even worth considering because of the totality of this. But that's what a collar is. It's a protection. It is a wash. You sacrifice the upside to protect against the downside. What's the advantage? If you're locked into a stock, so if you've got several thousand shares of stock from your employer and all of a sudden this market looks like it's going to tank and you're thinking, I can't sell these for another 18 months. What can I do? I can go sell 18-month calls and buy 18-month puts at the money. And for those 18 months, I've basically locked the gain in until I can either A, have the ability to sell them. That would be if you have a locked in period of time for whatever reason. IPOs might, well, IPOs won't have options yet. So that probably is not a good idea. It's really mainly if you're restricted, whether you're like an insider, whether you have, like again, stocks that if you have a stock purchase program, you buy your stock at a discount, you're usually locked in for a certain period of time. So if that stock, you are concerned about it, you could collar it. If you have a portfolio full of stock that you don't want to start liquidating, again, because it might disrupt your tax scenarios. If you have gains that are close to the 1 year and you want to extend them into the 1 year, that's how you do it. You are basically sacrificing the upside. You're capping it with by selling, and it doesn't matter if it's a stock or let me show you another scenario. Let's go back in time and say that we had bought a January 2023 option. No, let's go January 2022. But we bought it a year ago. So let's go, let's say we bought a 60. And let's say we bought it back on, I love doing some back in times, October the 15th. And on October the 15th, this day here, the 16th, when the stock was at 57.50. Okay. On the 16th, when the stock, let's try $8 to start with. 50. Oh, look how close I was. Let's get that a little bit closer. Right about here. So if on October 16th of 2020, the stock was at around 57.50, instead of buying the stock, I bought a long-term call, right? Went out quite a little ways. My buddy Tom Sosnoff just started his webinar. Tom is an old friend of mine, actually. We worked together a number of years ago. Yeah, one of the smartest options traders I've ever had the pleasure to work with. Very, very, very nice guy too. Yeah, definitely. If you can say hi, you're like, hey, I'm on the webinar with Scott Beck. He says hi. That's hilarious. Okay, so where would we be now? We'd be on let's do 5 contracts like we were gonna do here. So it's not as much, right? 5 contracts. I don't actually make as much money as if I had the stock. Remember that even though I had a good delta, I don't have a delta of 1. So in fact, at that point in time, this was a little out of the money. So it worked out pretty well. I've got $6,000 in gains. Same situation. Instead of buying the stock, I bought the leap. So as I buy the leap, can I still protect it? Yes. If I sell this $75 strike, it actually turns this into a spread. I have no problem. It's not naked. I am covered by the calls that I own here. It's not a covered call because it's a spread trade, because I have 2 spreads. It's theoretically a big diagonal spread, in fact, because I have different strikes at different expirations. Not by a lot, but a little bit. I could just take these out if I wanted to and just say, hey, let's protect it all the way until January. 285, 470. So really it'd be about the same thing. Nope, I'd still go 350 on each of these. And if I hit this, what do I have wrong here? This looks more bearish than bullish. I have something off. Sell 5 calls to buy 5 puts. Well, here's what you'll notice. This is a little bit imbalanced. I'm trying to figure out why. Because what this does is actually makes this more bearish than not. So I could probably go a little bit out of the money. Let's go to the 80s. No, reverse that. Now, when I start with this, you might think this is actually locking in a gain of at least 3,100. This wouldn't be a terrible idea because it locks in a gain of 31, but gives you huge downside potential to start to increase. But what I would actually do here is probably go a little further out of the money. And that would reduce the amount of premium, but still locks it in pretty well. So it's a little bit different scenario. However, what I want you to notice is you still have locked in gains. You can see this is around that 4 or 5K level. And this actually gives you more upside potential to the downside, because what will happen when it's all options is that these puts will eventually start to outpace the decline that your calls are making. So that's because of the shift in the deltas. You'll actually have this turn into more of a bearish trade. It actually gives you more protection. Maybe gives you a little less ability to lock in your gain, but more protection, and actually turns it slightly speculative to the downside. I haven't looked at a collar on a long-term option in a while, but it does have a little bit of an interesting perspective to it. So that's it. What are we trying to do? Protect from dropping. What do you have to get to protect it and not pay out of pocket? Because if all you want to do is protect it, buy a put. Boom, you're hedged. Buy a put for 3 months, you're hedged. The problem is, if all you do is buy the put, let me show you that. Let me go back. I'm going to actually take off the long-term option. I'm going to go back to December to what we had. That's what we were used to. Back to 350 for both of these. And put this on. 500, 5. Let's make this 75 to keep everything consistent. Whoops. Okay, so this is what we have. What would just buying a put look like? It would look like this. So it would protect your gain, but by I would drop by $1,800 instead of making $8,800. If it drops below 75, I'm only making 7,000. Why? Because I'm losing the cost of the put. So the entire strategy of a collar is to produce the money you need to buy the put by leveraging the ownership of the stock, or if it is the option, and that allows us to sell the call against it, use those proceeds to buy the put. Now there's no out-of-pocket cost, but I still have the same level of protection. So this trade, I am locked in at 75 all the way through December. So if at the end of December, it's at 75, well, I might be able to, if it's at 75 at the end of December, and I don't want to sell the stock, I can probably close, not probably, I can close the collar and uncollar it. I'm not locked into the collar any more than I'm locked into a covered call. So I can uncollar it and then decide, do I want to keep holding it now? Do I want to collar it for another 3 months? I have a lot of flexibility in that. So yeah, going back to Cecil's original comment that it's a wash, that's exactly, you're washing to lock in a gain. Why would you want to lock in the gain? Because you need to, for time. That would give you a short-term wash to get your holding to the long-term finish line, and now you've reduced your tax implications. Or you're locked into holding something, whether it's an employment restriction, something along those lines. That actually makes a lot of sense as well. The last consideration would be if you just have a bear market and you don't want to sell everything. Maybe that would create a lot of short-term, because remember this, let's say you sell a bunch of things. If you sell a bunch of things and take losses, or you sell a bunch of things and have gains, you only have the ability to write off $3,000, right? And then you have carryover, carryover, carryover. It's always easier to get things in the long-term category if possible when you have gains, because you'll never pay less than 15%. Now, I don't know a ton about that because I don't have a lot of trades that go a year. So this is not a strat. I don't have a stock or an employer that pays me in stock or has a stock purchase program, and I don't have a lot of trades that last for close to a year, and I would want to extend them. So that's it, right? That's it. It's not a strategy that I use a lot. Do I hedge? Yeah, right. I do hedge. Now, can you do short-term callers just to get you 3 or 4 days? Yes, but you put yourself at much more risk. Like if you're doing like a 1 month sell the covered call to buy the put, and then all of a sudden it takes off on you, there's nothing you can do. So if you collar it because you're worried about the drop, you're gonna put yourself in a situation where the market pops, and then you're like, oh crap, I couldn't get out of the collar in time, and now it's over top. Just saw where Mark Zuckerberg sold 77,000 shares, almost 30 million of his Facebook at 381. What does that tell you? Um, well, I think he's got so many shares. You know what I mean? Like, um, and I doubt he has any restrictions on any of his at this point because he's been there so long. I don't know. I don't know that there are any implications to that, right? Why did he want to create 30 million in income? Maybe he wanted to buy an eighth house somewhere or whatever. I don't even know. Why would a person, I mean, his holdings is like 50 billion worth of Facebook. So 30 million worth of shares is really, really minute relative to what he has. My thoughts on keeping a collar on a stock you're using for monthly covered calls. So that's kind of a hybrid collar. So you're saying sell a covered call, a little out of the money to buy a further out of the money put. So instead of doing maybe something like this, I could buy the 70 puts. And these are going to be a little bit cheaper, maybe $1.50, something like this, right? And so what this does is it does give me the ability to make more money to the upside. And it says that I'm not going to keep $8,000, but I can keep 7,200. It's a little better than a hedge. It still gives you a hedge, but it's a hedge below 70 with a lot more ability to make money above you. So I think that's actually a decent compromise if you think I would never do this. But if you were doing covered calls and you said, hey, rather than a dollar for dollar hedge, I could get a hedge $5 below, $7 below, where I say, hey, I'm willing to give back 10%, but not more than that. Yeah. Yeah, then that makes sense, because what you're doing is now, of course, you still have risk of getting called out. That's the biggest thing. Is if I'm selling a 75 call at the end of the time, I'm likely to get called out as it's going to be in the money. So there's still a sacrifice there, and the sacrifice is still going to be upside potential. Yeah, right. Maybe Zuck needs to buy another island or another yacht or something. Who knows? Who knows? Okay, a question came in early that said someone had option spreads, so the market had very little impact. He was mostly collecting decay. He would not tell. All I know, he was always rolling the decay, always rolled before they expired. Um, you know, when people kind of show things and talk about things like that, that could be calendar spreads. It could be iron condors. You don't really roll iron condors. You tend to roll calendar spreads. You buy out in time, you sell at the money. But anytime you're doing a time strategy like that, you have directional risk. If you're doing a directional strategy, you have time risk. I mean, there's always something there. So I would try to find out and bring it to us, and I'll show you. The big thing that a lot of people don't do in strategies like that is they don't say, what does ugly look like? There's not a lot of ugly in this strategy. Ugly would be if it goes to 100 and you have a collar at 75. It's not that ugly. You didn't lose money. You lost opportunity. That's the worst that can happen in something like this. It's similar to covered calls. What's ugly? Ugly is if the stock drops and it drops faster than the premium you collected. Then you're down, but you're actually down less than if you would have only bought the stock or if you only held the stock. A covered call is ugly if it takes a huge move up and you're capped. And you're like, oh, I own it at 75. I sold the call at 80. Now it's at 100. What can I do? Nothing. Sit back and wait until someone pays you 80. That's all you can do at that point. So sometimes ugly isn't necessarily things went against you, but things went in a way that you no longer benefit. Well, that sucks, right? If you got onto a stock and you're like, oh, it's turned sideways and I'm gonna sell some calls, get some premium, and then that stock breaks out, yeah, you're there's not much you can do. Can you roll a bull put spread if the stock drops? You can always roll directionally. Where let's say you do a bull put spread, it drops down. You're at a loss though, right? If you have a bull put spread and the stock drops, you're losing money. Can you get out and sell something closer to the money? Yes, but remember that whatever you roll to, if you ever roll a losing trade, the new trade has to be able to both overcome the old trade's loss and still make money as a new trade. That is an uphill proposition. I am not a huge roller because people always are like, oh, you just have to roll it. All you got to do is roll it. It's like if someone ever says all you have to do is be suspicious. When you roll a trade, you're starting a new trade. You're closing an old trade, starting a new trade. If you're closing the old trade for a loss, the new trade has to be able to make enough to overcome the loss and then profit on its own. That's harder. Of course, it's harder, right? Can you do it? Sure. Is it maybe, on a slippery slope? It can be. Rolling a calendar spread is rolling for a profit, right? If I can buy back the option I sold for a cheaper price and then go sell that same option a couple weeks later, I'm going to roll for a credit. It's going to extend the trade and show more of a credit. So that, to me, is a strategy that would make more sense. So there it is, collars. So if you ever hear someone like, oh, collar it, you could be like, well, I don't know, right? I mean, you can see what the exact rationale would be that would make it make sense. Collaring for the sake of collaring, I think you're better off getting out and moving that money somewhere better. If there's no valid reason that you need to stay in for 3 more months or 5 more months, then consider just simply getting off the tracks if you think that the train is coming, right? A lot of options, lot of option strategies there can be, right? They all have very different things, how they behave relative to price, time, and volatility and changes in those underlying variables. So that's a collar. If you never own stock, if you never have leaps, you're probably not going to collar something. You're probably just going to be a short-term trader. If you find yourself in a situation where you have stock and you have a limitation on when you can sell it, then collars can be very, very useful. Like I said, Cuban looks like a genius now, right? Because the Yahoo stock did collapse, right? So in 2001, when Yahoo collapsed, and I think it fell, the NASDAQ was down 85%. I think Yahoo was down at least 80 to 90%. Yeah, he would have lost 80 to 90% of his value. As it was, he locked it in at a certain price, got to that date, exercised everything, and boom, right? His calls that he sold expired worthless. he was able to buy them back for nothing because they went worthless. His puts had a ton of intrinsic value, was able to sell them and boom, right? Or exercise them to sell the stock, in which case when he sold the stock, it was a long-term gain at a high price, best case scenario. So like I said, if you ever sell your company to another firm for shares, this could be a very valuable strategy to you. Or again, I think the most useful would be, as I think about it more and more, company shares, right? If you have a stock purchase program that you can buy your company at a discount, but you're locked in for a period of time, collars can be a great way to lock in gains. What do I use to pick strikes on butterflies? Butterflies is a neutral trade. So first thing I'm going to do is be neutral on the trade, and then depending on the stock and the price of the stock, I'm going to try to build it as wide as I can without starting to make it too expensive. That would probably be the best. Butterflies obviously deserve their own entire hour, if not more. But you're buying the wings and selling the guts. Well, the wider I sell the guts, the more room I have. But the wider I sell the guts, the less I collect to pay down what I paid for the middle. Anyways, there you go. Okay, well, that's our discussion on collars. I hope at least collars make sense. You can see how and where you would use them. Certainly, you have the ability to offset them a little bit. Right? I can sell out of the money and buy out of the money, and that gives it a little bit more give, a little bit more leeway. DXCM Insiders just sold 6 million at an all-time high, 559. Here's what I'll say about insiders and insider selling. Insiders sell for the same reason we do, which is any number of dozens of reasons. Insiders buy for one reason, because they think the stock is going up. So if I see a lot of insider buying, I think that's bullish. If I see insiders selling a little bit, I really don't see a lot of implications out of that, right? I mean, they'd really have to sell kind of a lot for me to be like, oh, the rats are getting off the ship. 6 million at an all-time high, that's just, whatever. Like we said, you're buying a car, you're taking a trip, whatever it may be. For future workshops, would I consider walking through a leap, diagonal, how to manage when the stock drops? I think, a diagonal is a diagonal. I think we have some on there, but yeah, I love talking about diagonals. Okay, well, I will see you guys, at least in this situation, in 2 weeks. What is the next active investor workshop? Do we know? I guess we don't know yet. We'll know soon. Couple of days, we'll know what the next one is. If you're in the trading room, I'll see you tomorrow, not in the morning. Vlad will be here in the morning. Make sure you ask about any trades, because you won't see him again until Friday afternoon. I'll be here Thursday afternoon, Friday morning. I'll be here Thursday morning and Thursday afternoon, and then Friday morning. And then we'll wrap things up. So have a great rest of your day. If I don't see you again for 2 weeks, I'll see you in a fortnight. The rest of you, I hope to see you soon. If you're on the fence about joining, get off the fence. Join. Start using it. It'll work. If it doesn't, you've got 30 days. Have a great rest of your day, and as always, happy trading.